All right, hi everyone. Welcome to today's webinar brought to you by Vantage Markets, where today we'll be taking a look at the central bank spotlight, uh, which will be today RBNZ, right? The Reserve Bank of New Zealand. Right, take note, we're streaming directly into the Vantage app as well as over Zoom, right? Yeah, for those who are tuning in through Zoom and the Vantage app itself. All right. All right, welcome everyone. And before we start today's webinar, right, let's quickly go through the disclaimer. Right, take note that the information, context, and opinions which are expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage, and are solely used for educational purposes, as they do not constitute investment advice and or consultation on how a client should trade. Also, take note of the risk warning that comes with trading margin forex and CFDs, as they carry significant risks and is not suitable for all investors. My name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between Vantage Markets and Evans Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, so we'll be looking at the RBNZ monetary policy meeting that took place 2 weeks ago on the 22nd of May. Right, so we're going to look at some of the key takeaways from the statement, as well as any significant shift in messaging from the RBNZ and specifically from Governor Adrian Orr during his press conference. And also we'll take a look at what does it mean for the Kiwi moving forward. Right, so here are some of the key takeaways from the statement. Right, first of all, the monetary policy statement was released on Wednesday, 22nd of May at 2 a.m. GMT time, right? So prior to the release of the statement, markets were already anticipating no change to the rate cut, to the cash rate, to the official cash rate. It currently stands, it currently stood at 5.5%, and that's where it stands now as well. So as widely expected, the RBNZ left its official cash rate on hold at 5.5% on the 22nd of May for the 7th consecutive meeting, right? So the statement added a few, well, the statement highlighted a few important points, right? The board notes that restrictive monetary policy is contributing to an easing in capacity pressures, right? So that means they're seeing the economy, some slack in the economy, while headline inflation, core inflation, and most measures of inflation expectations are continuing to decline, right? So we're seeing the trend continuing to move lower. We see inflationary pressures continue to dissipate in New Zealand. However, uh, these all these measures of inflation are still well above the committee's target band of 1 to 3%. So take note, the RBNZ has an inflation target band that ranges from 1 to 3%. And looking at all the three metrics of inflation, right? Headline inflation, core, and inflation expectations, all of which are, although they continue to decline, they're well above the target of 1 to 3%. So although inflation is or the rate of change of inflation is heading in the right direction, it is still not achieved or reached its target just yet. Right. What are some of the things that are keeping inflation elevated? Right. We are seeing higher dwelling rents, insurance costs, and council rates, and other domestic services as well. And this has translated into higher price inflation, right? And has resulted in a slower decline in domestic inflation, right? So this poses a risk to inflation expectations. Also, on the economy side of things, GDP declined by 0.1% in the fourth quarter of 2023, with economic growth now being negative in the 4 out of the past 5 quarters. So as you can see, the Kiwi economy is pretty fragile, and inflation continues to remain persistent or stubbornly sticky, right? Higher interest rates, as expected, have reduced household spending, as well as residential and business investment, despite a very strong population growth. And also, recent indicators of economic activity have been weak, right? So these recent indicators are indicators such as the manufacturing and services PMI, which we'll be taking a look later on in the slides. Now, this meeting was conducted on the 22nd of May, which was 2 weeks ago, and the next meeting is up on the 10th of July. So pencil that in your calendar. Right, now looking at the official cash rate, this is the chart from the Reserve Bank's website. So this is a chart showing the level of the cash rate since 1999. And you can see here from the end of 2021 and early 2022, the rise in the cash rate has been pretty significant, right? The rate of change has been very quick, It's been a rapid rate of change in the cash rate, going from about, I believe, 0.25% to as high as where it currently stands now, 5.5%. Although it is nowhere near the high levels of cash rate that we saw in 2004 to 2008. But nevertheless, it is still a very rapid change or rapid rise in the official cash rate as well. Right? We all know this is all done by most major central banks to combat inflation, right? Central banks have limited tools at their disposal when it comes to taming inflation, and raising interest rates. It's one of them, right? This is the trade weighted index of the RBNZ. Now, what is this TWI? The TWI is a trade weighted index that measures the value of the New Zealand dollar against the currencies of New Zealand's major trading partners, right? The major trading partners would be China, the United States, Australia, and the EU, and other countries as well. So it's a basket of 17 countries that help measure or gauge the value of the New Zealand dollar. Now, this chart is also from their website. This is showing the value of this index from 2014 till the present, right? So you can see here, since it's an index level, it's just a number that's calculated from a baseline of, I would probably, I think around 50 maybe. If it might be calculated similar to the dollar index is a basket of currencies based with a baseline of 100. As you can see here, it's currently sitting at around 74, right? The index currently stands at 74. And now when we zoom in on the index from 2022 to the present time, you can see that it hasn't fluctuated that much. Okay, well, yeah, there's been quite range going as high as 75 in April of 2022 and dropping as low as 67 in October of that same year. However, when we look at it from 2023 onwards, it's sort of been ranging between 69 and 73 as well. So you can see here the New Zealand dollar hasn't really strengthened past the index level of 73 since the beginning of 2023. So nearly about 16 months now, where this barrier here at 73 has acted as a pretty significant resistance point here. Now, this is may be something to take note of as well. From a technical analysis point of view, we may see the Kiwi strengthen a little bit moving forward, but however, we may see it potentially stall around the index level of 73 and potentially drop back as well. Right. Now, was there any significant shift in messaging from the RBNZ? Well, we'll take a look at what are the key quotes from Governor Adrian's press conference was. Right. So as expected, inflation has continued to decline significantly. However, it is not near the target band of 1 to 3%. Right. So he expects inflation to fall back into this target band by the end of this year. And of course, he's taking it. It will take a slower time for inflation as well to reach this target because of higher prices, as we mentioned earlier here, right? Higher dwelling rents, insurance costs, council rates, and other domestic services are keeping inflation elevated or prices elevated, which is going to slow the decline. The economy has lower potential growth rate, has a lower potential growth rate, and is unsure if that is temporary. But when we look at the PMI indicators, it doesn't paint a very rosy picture. Okay, the board also has limited upside room for inflation surprises, right? That means they're not looking forward to that, and they may keep rates elevated as well. They are pleased with inflation expectations coming down, but once again, it needs to fall further, just like headline and core CPI. Now, the official cash rate track is a central projection, but it's not an absolute prediction. So they're giving themselves some leeway as well, just in case inflation doesn't head down as quickly as possible, right? And also, they had a real consideration on raising rates at that present meeting that took place on 22nd of May, right? So this was a pretty hawkish quote by him. And there's also a lot of high domestic inflation affected by near-term factors. So they're probably expecting inflation to remain sticky over the next couple of months, right? We may not see a drastic rate of change in inflation increasing, but is expected to probably stay elevated at the current levels before finally heading lower by the end of 2024. And what he also noted was insurance rates and rent costs are less sensitive to interest rate changes as well. Now, what happened in the immediate aftermath of the RBNZ meeting. Remember the RBNZ meeting? Or rather, the monetary policy statement was released on Wednesday, 22nd of May at 2 a.m. GMT time. So over here on this chart, I'm on the 1 hour time frame for the Kiwi. And you can see here prior to the release of the statement, the Kiwi was trading around 61 cents and it surged as high as 61.52, 0.6152, rising about 50 pips during this 1 hour period. After which it actually pulled back very sharply and was sort of ranging between 60.85 and about 61.30 until the end of the week before finally breaking out of this range as well. So the immediate reaction to this statement release was a spike in the Kiwi, right? Because of several things. Inflation's remaining sticky, and also the board had this statement, or rather, Governor Adrian Orr had this statement that there was a real consideration among board members on raising rates at that meeting. So a couple of bullish uh, catalysts that caused the Kiwi to spike on this day, but it wasn't a very sustained move. It pulled back very sharply, consolidated for a while before finally breaking higher. Now, what does this mean for the Kiwi moving forward? Now, before we look at the currency pair itself, let's take a look at some of the macroeconomic indicators for New Zealand. Right, we'll start off looking at GDP on a quarterly basis as well as on an annualized basis. Now, looking at the quarter-over-quarter growth for GDP in New Zealand, we can see that it entered a technical recession in the fourth quarter of 2022 and the first quarter of 2023. Now, what is a technical recession? A technical recession is simply defined as 2 consecutive quarters of negative growth. Right, so you can see here in the third quarter of 2021, there was a strong decline of 3.8%. However, in the fourth quarter, there was a strong rebound as well. So in this scenario, New Zealand avoided a technical recession. However, as we came towards the end of 2022, there was a decline in the fourth quarter by 0.6%. And in the first quarter of 2023, there was a decline of 0.2% as well. So this constitutes as a technical recession, which is what happened at the end of last year as well. In the second half of last year, New Zealand's economy contracted as well, having 2 consecutive quarters of negative growth. As you can see here, over the last 5 months, it's been a very poor activity in terms of economic output. So we can see that the New Zealand's economy is not exactly firing on all cylinders, right? You can see it's pretty fragile over the last 5 quarters. Now, when we look at it on an annualized rate as well, we can see that the third quarter and fourth quarter of last year were negative as well, right? So economically wise, New Zealand is not on a solid foundation, right? And when we look at the PMI numbers as well, it points to a pretty similar outlook as well. Now, before we look at the PMI numbers, let's take a look at the trade balance or the balance of trade for New Zealand. So as you can see here, for most parts of 2023, it was running a trade deficit. However, they've managed to reduce that deficit quite significantly with gaining and turning it into surplus in March of 2023 and April as well. However, there was a sharp contraction in surplus as well as it narrowed down to 900 million $90 million in April of 2024, down from $220 million in March, right? So although they've done the economy has done well to narrow the trade deficit and turn it into surplus, however, we see the sharp pullback, a sharp drop in the surplus. Now this is a bit worrying. Whether are they going to run into deficit once again? Right, as you can see here, among its major trading partners, exports decreased to China, Australia, and the USA, all which are, it's a worrying sign as well in terms from an economic standpoint. Right, moving on to PMIs. Now, PMIs are purchasing managers indices. So it measures the level of activity in the manufacturing sector as well as the services sector. Now, a reading below 50 constitutes contraction, and a reading above 50 constitutes expansion. So when you see the manufacturing PMI coming in below 50. 50 is over here, the index level of 50. When the reading is under 50, it indicates that the manufacturing sector is undergoing contraction. And a reading above 50 indicates an expansion for that particular sector. So in the case of services, services has been was expanding pretty well for most parts of 2023, but it has had a sharp drop in March and April of this year. Now, looking at manufacturing, it has been in contraction for 14 consecutive months. So, quite clearly, manufacturing, as in most parts of the world, has been in a downturn as well, right? Manufacturing activity has significantly declined over the last, I would say, 18 months for most major global economies. And it is the services sector that has actually been pulling up overall growth, which is what we see in New Zealand as well until the last couple of months, right? Although you can see uh, the PMI, services PMI flipping between contraction and expansion throughout 2023, right? And we started off 2024 on a strong note as well, with a reading of about 51.8 and 52 point, what is this? Is this, maybe 52.2? Right. However, we saw a sharp pullback in services activity in March and April, right? So looking at PMI numbers, right, is not a very rosy outlook, and this is also naturally going to have an impact on GDP figures for the first quarter and second quarter of 2024. Right. So looking at it from an economic standpoint, New Zealand is not on a solid foundation, and things uh, could remain as they are over the next 1 or 2 quarters. Right. Composite PMI is basically it's the combination or blend of the services and manufacturing PMI readings. And as you can see here, it was throughout 2023, although it remained mostly under the reading of 50, right, indicating contraction. It was pretty steady at the beginning of 2023. It dropped off, and then it has nice rebound coming into this year, but once again it has fallen back quite sharply as well. So yeah, looking at the manufacturing and services sector, they are not running as high as they should be. Now, coming to inflation, this is inflation on a quarterly basis. On the left, I have the chart for headline CPI, and on the left, I have the chart for core CPI. So as you can see, the direction or the trend has been to the downside, so that's great, right? Headline CPI on a quarterly basis was as high as 2.2%, and now it's dropped off to about 0.6%. And similarly for core inflation, which was as high as, what is it, 7.4% here, it's come down to as low as 3.7%. So the direction on a quarterly basis is good, but as we all know, it's not near the target of 1 to 3% uh, for that RBNZ, right? And when you look at it on an annualized basis, which is the year-over-year reading, right, it was as high as 7.3% in the second quarter of 2022, and now it stands at 4%, right? So quite clearly, the inflation levels, like when you look across the various metrics, most of them are not near the target of 1 to 3%. Hence, the RBNZ is quite likely to keep rates elevated moving forward as well. Now, looking at home prices as well, this is the chart for this is the house price index, the HPI, the house price index for New Zealand. On the left, I have the chart for the monthly change, and on the right, I have the chart for the annualized change. So house prices on an annualized basis had actually decelerated throughout 2023, but they sort of bottomed in the middle of that year, of last year, and started to increase higher, coming into and started to accelerate and coming into positive growth as well. So higher home prices as well, if home prices continue to increase, right, that's also another factor that plays into the fact that the RBNZ may keep rates at current levels rather than cut early. Right, consumer spending, when you look at consumer spending on a quarterly basis as well as on an annualized basis, we can see consumer spending has been pretty poor in New Zealand, right? We can see only in the first quarter of 2024, we saw an increase of 0.5%. This marked the first increase after 8 consecutive quarters of decline. So basically, we had 2 years of negative retail sales growth in New Zealand, right? And on the annualized basis as well. Of course, if on a monthly, quarterly basis, we're seeing negative, we're seeing declines in retail spending, that of course is going to feed into the annualized reading as well. Now, this poor or weak consumer spending can be attributed to a rising unemployment rate. When we look at employment figures in New Zealand, right on the left, I have the chart for employment change. This is similar to like the non-farm payrolls, right? Employment change. So when you see positive growth, it means that the labor market is strong and companies are hiring pretty aggressively, right? And of course, if we see declines in the employment change, that means they're probably hiring freezes going on at corporations, as well as layoffs coming into place or taking place. So if you look at it over the last 3 quarters, employment change has been mixed, right? Combination of 2 down quarters and 1 up quarter. And we can also see the unemployment rate has has risen quite sharply. It was as low as, I think, about 3%, roughly around 3% in the first quarter of 2022, coming to as high as 4.3% in the first quarter of this year. Now, of course, if unemployment rate is rising, there are more people, uh, there's more unemployed people, and that also would very likely feedback negatively into retail spending as well. And also we can see when we look at job vacancies, that has dropped off quite drastically since the third quarter of 2022 as well, right? So if companies are not hiring or have sort of reduced the number of vacancies, right, that means the aggressive hiring practices have fallen off, and companies are looking to consolidate their workforce, or even worse, perhaps start laying off people, laying off employees as well, right? So looking at employment is relatively weak. Consumer spending is weak. Home prices look to be accelerating. Inflation, although it is decelerating, still continues to remain high. Economic output is poor, looking at composite PMI and manufacturing and services PMI activity. And of course, looking at GDP growth, it is looking fragile as well. So overall, we don't have a very strong economic or we don't have a very positive economic outlook on New Zealand, but because of inflation remaining stubbornly persistent, it may be enough for the RBNZ to continue to keep rates at current levels. Now, let's look at the chart on TradingView and see what is likely to happen as well for the Kiwi. Now, when we look at the chart, okay, so first of all, this is the 1 hour chart. As you can see here, the Kiwi was trading at around 61 cents prior to the release of the monetary policy statement on Wednesday, 22nd of May, and it spiked as high as 61.52, and it sort of consolidated over this range before finally breaking higher a week later to climb as high as 61 cents, 61.70. Right. Of course, now when we look at the New Zealand dollar, US dollar, we're looking at a currency pair, so we also have to take into account what the Federal Reserve is going to do, right? So this is basically we have to look at the state of the overall economy in New Zealand and in the United States, and also look at what are the more likely actions by the Federal Reserve and the RBNZ, and which central bank and which actions are going to have a higher impact on this currency pair, right? So let's start the analysis with on the dollar, on the daily time frame, and then we can try and identify what are the key levels to watch out for, and how this currency pair could trade over the next week or so. Right. Okay. So just since the middle of April, right, since mid-April, we've seen the Kiwi bottom at around 0.5880 and has risen quite strongly, coming within a whisker of 62 cents. Now, part of this move or the strength in the Kiwi dollar is also due to weaker macroeconomic data out of America, right, out of the US. We've seen GDP, first quarter GDP being revised lower, right? The preliminary estimate as well as the advanced estimates have been coming in lower. We've also seen inflation coming in soft for the month of May, right? The latest CPI readings and PCE price index for the month of May have pretty much come in line with estimates, which is also has caused the dollar to sell off. And we're seeing as recently as yesterday, right, the ISM manufacturing PMI that was released in the United States pointed to another month of contraction, which also feeds negatively into the US dollar. So with with demand for the US dollar falling off since mid-April, this has caused the Kiwi to rise as well, right? So we have to look at the differentials between uh, the rate of change in inflationary pressures in between New Zealand and Australia, the rate of economic output between New Zealand and US, sorry, and the US, not Australia, and US, and try and identify what is also with that into consideration, we can then apply technical analysis and try and figure out what's actually going to happen moving forward as well. Now, we can see that, okay, and before that, going back to the trade weighted basket, remember we had a look at the trade weighted basket for uh, New Zealand, right? So the TWI, we can see that I mentioned that since January 2023, the index has not climbed above 73, right? Has been functioning as a pretty strong resistance barrier. So similarly, if you were to look at the chart for the Kiwi, so since 2023, we should see a similar resistance level as well. So let's take a look at that and see if we can spot it. So let's go on the weekly time frame and see from the beginning of 2023, right? There is a pretty clear resistance that we can identify as well, right? So generally you can see that there's a major swing high resistance here that's occurred in December of 2023. There's another swing high resistance here on July of 2023, right? This is a swing high resistance here, another swing high resistance here, and we can also see Kiwi running the resistance on February 2023, April, and May as well. So this highlights a pretty significant resistance level at 63.89. So this is something to take note of as well, right, on a slightly higher time frame. And the next resistance that comes in is at this level here, which is around 65 cents, right? So it's quite important to understand where the limits for the TWI as well as for the Kiwi sit at so that we can identify major resistance and support areas as well. Right. Okay. So we can see this is quite clearly a major resistance area at around 63.20 and a major support area between 58 cents and 58.90. Now let's go back over down to the daily time frame. Right. So something more actionable in terms of a near-term resistance. We can spot it here. It is at pretty much at 62 cents. And we can see a nice swing high resistance taking place on February of 2024, and then again on March as well. And then as the Kiwi peaked at about 63.50 at the end of last year, it pulled back. It sort of consolidated around this level as well. So this was previously a pullback support level, which then proceeded to function as resistance. You can see quite nicely the Kiwi bouncing into or bouncing off this level here to create an overlap. So this is a very significant overlap resistance level. And if I look across all the way back to December of 2023, we can see once again the Kiwi running the resistance here, pulling back before finally breaking higher, finding support here in January this year, breaking down, then consolidating, and then running the resistance at this overlap once, twice, and over here you can argue as well, it came pretty close to this level before stalling. Now, quite clearly, this is a very significant overlap level, which is what we're going to use to identify as the first major resistance for the Kiwi on a daily time frame. And because we also see the Kiwi running the resistance yesterday and around here, this is more of an intermediate resistance that I would like to highlight as well, which is at 61.90, intermediate resistance at 61.90, and first major overlap resistance at 62.08. Now, with regards to support, right, there's a pretty strong support level here at 60.85, right? We can see as the Kiwi was pulling back last week, it found support here on Wednesday and Thursday, or 2 weeks ago, sorry, 2 weeks ago, I found strong support here, bounced higher, pulled back again last Thursday, finding support here before bouncing higher again. So this looks like a very strong support level for the Kiwi. And then when we stretch it across, we can see that it's actually a pretty significant overlap level as well. You can see here the Kiwi running the resistance on 21st of March and making the swing high resistance here on 10th of April, after which it broke out of this level here, made a pullback on 23rd of May, then again on 30th of May before bouncing higher. So this creates an overlap level, right, a very significant overlap level at 60.79, which is what we're going to use to identify as our first support. Right. At this point, we can also use a couple of Fibonacci retracements, right? We're going to start the retracement from here. This swing low on the 19th of April, going up to today's high. Let's pull up all the fibs and see what we get. Right, we can see that the 38.2% Fibonacci retracement aligns quite close to the first support. And because we can see price making a pretty, the Kiwi making a pretty decent pullback at around 61.10. Here, I would like to identify this as an intermediate support that also has the presence of a 23.6% Fibonacci retracement. Right, so let's add in okay, so in this case, let's keep the 23 and 38.2% Fibonacci retracement. Right, then what about resistance, right? We can run a Fibonacci retracement from this swing high on the 28th of December down to the swing low on the 19th of April. Let's pull up all the fibs again. Perhaps the 78.6 that we can use. All right, now we can see Kiwi has already broken above 61.8%, but you can see here back on 28th of May, this is where it ran into resistance at exactly the 61.8% Fibonacci retracement, pulling back over a period of 3 days, stabilizing, and then finally bouncing higher again. So we can see how the 61.8% Fibonacci retracement did help us identify a significant barrier in the rise to the Kiwi, pulling back and then going higher once more. Now we can see that the 78.6% Fibonacci retracement sits slightly above this consolidation zone here. So perhaps if we do see the Kiwi rise strongly, right, breaking above this first major resistance, then the next resistance is likely to come in at around this level here, which is this where the 78.6% Fibonacci retracement sits. Right, so with that, let's just keep 78.6 and get rid of all the other levels. Now, we can see demand for the dollar being pretty strong today. So if you look at the dollar index, the USDX is the dollar index. So we can see here, once again, I'm on a daily time frame. Dollar index has actually been selling off quite strongly since last Thursday, even yesterday as well. Remember, we had poor macroeconomic data out of the US, specifically ISM services PMI, which sort of accelerated the bearish momentum, causing dollar index to drop as low as about briefly falling below the level of 104. However, we see dollar index rebounding today, perhaps after 3 strong days of sell-off. Right, we're likely to see some retracement to the upside as short traders close out their positions. Remember, for short traders to close out their positions, they need to buy back that particular instrument. So in this case, they're buying back the dollar. So that means we could see a nice dollar bounce today as well, right? Maybe continuing today until tomorrow. So that is why we're seeing this as well. So not only did the dollar hit a strong support level, once again, this is a strong support level for the dollar index here at about 104, which is where it seems to have found support once again. Okay, so coming back to the Kiwi, we could see the Kiwi continuing to pull back for the rest of today. And then depending on the data that's coming up today we have Joel's job openings in the US. So that's a labor market indicator. So if we see that data miss. That means it comes in weaker than expected, right? That means there's less vacancies in the labor and the in the labor market, or there's less vacancies being advertised by U.S. corporations. It signals a potential slowdown in the labor market as well, and that could cause the dollar to come under pressure once more. So take note, we've got Joel's job openings coming up today as well, and that could impact the direction of the Kiwi too. Wait, let me check. Is it today or is it for some reason? Oh yes, that's tonight. Yes, that's right. That is tonight. And just let me bring it up. Yep, here we go. Just let me bring it up here as well. So we have today, June 4th. So at 2 p.m. GMT time, we have Joel's job openings. The previous figure, this is for the month of February, came in at about 8.5 million openings. And for March, the estimate is at 8.3, 8 point, pretty much 8.4. So if we see a figure that's lower than this estimate of 8.37 million openings, this is quite likely going to function as a bearish catalyst for the dollar. So if that was to happen, the dollar is likely going to sell off. And that would mean we could see the Kiwi potentially stabilize and reverse to continue this uptrend here as well. So looking at the daily time frame, I also see a nice ascending trend line for the Kiwi, right? A pretty decent ascending trend line. Or rather, it's more of a bullish channel as well, right? I think I can highlight this as a bullish channel. I see a nice bullish channel for the Kiwi. Right, so we could see Kiwi continuing to pull back today until we see the Joel's job openings data, and should we see a reading or a figure that comes in less than 8.37 million, we're likely to see the dollar suddenly sell off, and that may be enough for the Kiwi to stabilize and resume its uptrend as well. So take note, the lower trend line of the bullish channel can help us identify a potential support area as well. And now looking at this price level here at around 61.50, I also see another pretty decent intermediate support level as well. Right, so we can see the Kiwi running the resistance here on 22nd of May, 27th of May. We can argue here on 28th of May, it ran into resistance here as well. Then on the 31st as well. So you can see this level here at 61.52 previously functioned as a pullback resistance. And of course, with now price trading above it, with the currency pair trading above it, this level here at 61.52 could offer could help us identify a potential support zone. So should we see the Kiwi stabilize around 61.52, and then we see job openings in the US come in lower than the estimate of 8.37 million, we are quite likely to see the Kiwi bounce off this level to resume its uptrend. So take note of that, of how today's data out of the US, which is Joel's job openings, could impact the direction of the Kiwi. Now, of course, the opposite could happen as well. If we see a strong number for job openings, this is likely going to accelerate the demand for the demand. Is likely going to accelerate demand for the US dollar. So that means, of course, this fall in Kiwi is likely to continue further, and we could see it break below this intermediate support at 61.52. Right? Take note of how the data could drive uh, the direction of the Kiwi. But I think we are likely to see a weaker number, right? Labor market, although a US labor market is still somewhat robust, right? We are seeing the rate of change of NFP, monthly NFP slow down, ADP slow down as well, right? So maybe, and we are also seeing job openings trend lower. You can see job openings were as high as 11.6 million back in 2 years ago, and they've actually been in a downtrend as well. So we can see job openings have not actually reversed; they've actually continued to decline. And this is something that we may see in the latest print as well. So if that were to happen, if you were to see further decline in the level of job openings, this is likely going to function as a bearish catalyst for the US dollar. So that means we could potentially see the Kiwi stabilize around its intermediate support level at 61.50 and then reverse to continue its uptrend. Right. Okay. What else do I see? Anything else on the Kiwi? And also we've got the FOMC meeting coming up next week, right? Because that's important as well, because that's also going to impact the direction of the of the Kiwi. We got FOMC coming up uh, next week. Yes, so the meeting concludes on 12th of June, and that's where we'll get the release of the monetary policy statement, as well as the press conference by Chairman Jerome Powell. Now, with inflation in the US, at least with the latest figures for CPI and PCE price index for the month of May coming in line with estimates and pointing to an overall soft reading, right? The Fed may be inclined to adopt a more neutral approach, and even perhaps Chairman Jerome Powell, could even signal or lean more on the dovish side, right? He may not signal interest rate cuts just yet, but he may lean on the dovish side, given that we've seen May's inflation data in the US come in pretty much in line with the estimates, pointing to an overall softer inflation reading. Now, if that were to happen next week, we're likely to see the Kiwi climb higher as well. Now, of course, that's a week away. Anything can happen between now and then, but generally this is something to look out for as well, right? So moving forward, interest rate decisions by the Fed is also going to have a huge impact on the direction of the Kiwi, and this is something to take note of as well. All right, okay, so these are the key levels for the Kiwi on the daily time frame, and also how today's data, specifically Joel's job openings out of the US, could impact the current direction as well. Now zooming in into the 4-hour time frame, let me see if there's anything else that I would uh, like to point out. Pretty much no. I think not really. Yeah, I think that is fine. All right. Okay. So before we end today's webinar, right, we're coming quite close towards the end. I'm just going to launch a poll. Truly appreciate it if you guys could give your feedback with regards to today's session, and we'll look through what we've covered today. We'll just do a quick summary of what we've covered today before we wrap up today's session. All right, thanks for the feedback. Truly appreciate it. I'll keep the poll running for another 30 seconds or so. And then we'll just wrap up the session by looking through, doing a quick review of what we've covered today. All right, great. Thanks, everyone. Right, truly appreciate the feedback. Right, just close the poll. And now we'll just wrap up with what we've covered today. All right, so today was a spotlight on the RBNZ, the Reserve Bank of New Zealand. Right, we looked at what were the key takeaways for the meeting that took place 2 weeks ago on the 22nd of May. Uh, we saw that, as widely expected, the RBNZ left its official cash rate unchanged at 5.5% for the seventh meeting in a row. Right? They see restrictive monetary policy. They see monetary policy is still restrictive enough and is contributing to an easing in capacity pressures, while headline inflation, core inflation, and inflation expectations continue to decline, but at a slower rate. And of course, we also took a look at the CPI still remains well above the committee's target band of 1 to 3%. Right? Part of the reason of the slower decline in inflation is due to higher dwelling rents, insurance costs, council rates, and other domestic services price inflation as well. GDP is weak, right? It has been GDP output or GDP growth has been weak out of the four out of the last 5 quarters. And the committee has also noted that higher interest rates has having a significant impact on reduced household spending, right? This is being reflected in consumer spending as well. And of course, for residential and business investment. And also the recent indicators such as PMI activity have also been weak and is naturally going to feed back into GDP output as well. The next RBNZ meeting is on the 10th of July. Right, so you can see here, this is the the chart for the official cash rate from 1999 to present. Here we have the TWI, or the trade weighted index, which measures the value of the New Zealand dollar against the currency of its major currency trading partners, right? This would be the Chinese yuan, United US dollar, Aussie dollar, the euro, and other currencies as well. Right, looking at it, looking at the TWI, on a shorter time frame over the last 2 years, we can see that the index level of 73 has acted as a pretty significant resistance level, which is also similar to the resistance area that we had identified on the chart for the Kiwi as well, which is the New Zealand dollar, US dollar. So paying attention to this as well also helps us identify how far the value of the Kiwi could potentially rise as well. Right, we saw a pretty much um, not a balance, slightly hawkish, I would say a slightly hawkish press conference by Governor Adrian Orr, right? So specifically with considerations that the board members had a real consideration on raising rates at this meeting. And also a lot of high domestic inflation are affected by near-term factors. So they expect inflation to remain elevated over the next 1 or 2 quarters before finally heading lower by the end in the fourth quarter of 2024. And we also looked at what was the immediate reaction to the Kiwi in the aftermath of the press release on 22nd of May. We saw the Kiwi spike from about 61 cents to about as high as 61.52, pulling back, consolidating for a while before finally breaking higher. Right, and we also looked at GDP growth. We can see on a quarterly basis, New Zealand actually entered a technical recession back on the fourth quarter of 2022, early 2023, as well as in the second half of last year, entering into technical recession for the second time in 2 years. And on an annualized basis, we can also see GDP output has been negative in the third and fourth quarter of last year. So quite clearly, the economy is pretty fragile, and the outlook is looking is not great as well. What is a little bit positive is trade. The trade deficit has narrowed gradually throughout 2023, and then it's finally turned into a surplus in March and April. However, April's figures saw the trade surplus narrow quite sharply, and this is quite worrying because the balance of trade may slip back into deficit once again. Now, looking at manufacturing and services PMI, a reading under 50 indicates contraction, a reading above 50 indicates expansion. So we can clearly see manufacturing activity in New Zealand, as in most other developed countries as well, have been in a downturn, and specifically for New Zealand, it's been contracting for 14 months in a row. Services had been relatively strong, but that has plunged as well in the recent months, which points to a weak second quarter GDP output as well. Right. And on the composite level, which is a blend between the manufacturing and services PMI, we can also see a sharp fall off in output. Right, looking at inflation on a quarterly basis, it is trending lower. Right, it is trending lower on a quarterly basis and annualized basis, but you can see the current reading of 4% is still well above the target of 1 to 3%. So that is why this is also part of the reason why the RBNZ is inclined or reluctant, I would say, inclined to keep rates at current levels and reluctant to cut too early as well. Home prices, which were decelerating throughout 2023, sort of stabilized in the middle of last year and have started to accelerate. And this is also another factor that would feed back into the decision-making process for the RBNZ, because if home prices continue to rise quite steadily, right, that also is going to have an impact on overall CPI levels as well. Consumer spending, as we've noted, has been pretty dismal, right, on a quarterly basis as well as an annualized basis. And part of that can be attributed to rising unemployment rate and poor employment growth over the last 3 quarters as well, right? And also, job vacancies have dwindled from the middle of 2022 to the current reading of last year, the last quarter. So job vacancies have also dwindled, which signals potential hiring freezes by most most New Zealand corporations as well. All right, thanks everyone for tuning in to today's webinar. Hope you have found this to be a great session. Do look out for all upcoming webinars by Vantage Markets for the rest of this week. Right, I wish you all the best in your trading journey and catch you all at the next webinar. Right, thank you. All right. Okay. Right. I will check with Vantage about this if they are going to email you the slides. But do take note. Um, this recording will be uploaded onto the Vantage app itself, right? So do look out for that. If you've not downloaded the Vantage app, please do so. Register an account, and you are able to watch a replay of this webinar in due time. Probably by the end of this week or maybe early next week, it should be up on their app. So do take note of that. I don't think Vantage will email the slides to the attendees directly, but you can rewatch this at a later date once it's uploaded onto the app. All right. I hope that helps you. All right. Thanks, everyone. Take care. Have a great trading week, and I'll catch you all at the next webinar.